Hello and welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX listed universe. I'm your host, Olivia Grace Curran. Global stocks were mixed overnight, with Wall Street struggling for direction, while the German election brought some relief to European markets. Wall Street experienced choppy trading, the S&P 500, NASDAQ and Russell 2000 finishing in the red, the Dow ending in the green. Technology stocks the biggest drag as investors awaited results from chip giant Nvidia for clues on the future of demand for AI technology. Microsoft shed around 1% after an analyst report from TD Cowen said the company is cutting spending on data centers. Apple reversed pre-market declines to gain more than 1% after the iPhone maker unveiled plans to spend $500 billion in US investments in the next 4 years, including setting up a giant factory in Texas for AI servers. US-listed shares of Australia's Telix Pharmaceuticals rose after Norway approved its prostate cancer imaging agent. Domino's Pizza slumped after missing fourth quarter same-store sales estimates. Berkshire Hathaway shares were up after hitting record highs earlier in the day after Warren Buffett's conglomerate reported a record annual profit. Nike added more than 5% after Jefferies raised its rating to buy from hold. Starbucks shares rose on the global coffee giant's plans to eliminate more than 1,000 corporate roles as part of its CEO's turnaround efforts. And European markets fell as traders reacted to the results of the German federal election. The Stock 600 index closed lower, weighed down by France's CAC, while Germany's DAX closed 0.6% higher. Shares of German defence stocks rose sharply, with bellwether Rheinmetall up nearly 5% to near a record high, touched last week on hopes for a Ukraine ceasefire. US President Donald Trump says that sweeping US tariffs on imports from Canada and Mexico will go forward as scheduled. Speaking at the White House on Monday afternoon, the president claimed the US had been taken advantage of by foreign nations on just about everything and reiterated his plan to impose so-called reciprocal tariffs that had been delayed for 1 month. Meanwhile, US Treasury yields were slightly down, with benchmark 10-year yields hitting their lowest in more than 2 months, falling 1 basis point. 2-year yields were unchanged at 4.19%. Markets are waiting for inflation data that could help gauge the timing of the Federal Reserve's first interest rate cut this year. The US dollar briefly fell to its lowest in 2 months on US growth concerns. The euro has pulled back from earlier highs after briefly rallying following the election victory of Germany's Conservatives. And 1 Aussie dollar currently buying 63.5 US cents, while Bitcoin has slipped further, currently around 92,000 US dollars. Oil prices edged higher on Monday as fresh US sanctions on Iran and a commitment to compensate for overproduction by Iraq added to concerns of near-term supply tightness, helping the market recover some of Friday's steep losses, while gold prices surged to a record high of $2,956 US dollars an ounce, driven by safe haven demand amid concerns over US President Donald Trump's tariff plans. For more on markets, Steve Sosnick from Interactive Brokers joins me now. Great to see you, Steve. So choppy trading on Wall Street overnight. Take us through what happened.
Good morning, Olivia. Great to see you. Well, I think this morning, there was a real test. And when I woke up, S&P futures were up about 20 points and then sort of advanced up 30. It's something we see a lot, sort of the pre-market advance, because I think at this point, a lot of U.S. traders are pretty much conditioned to wake up and figure the market's going to go higher. So I think literally many of them hit snooze on their alarm clock and then hit the buy button on futures. But there was no follow through. We were up 30 all morning, and then pretty much as soon as the market opened, down they went, and they actually went down pretty hard initially. Then we got another round of buy the dip, but it never really materialized, and then another reminder that tariffs are more likely than not was the last thing the market needed, and we sold off in the last 50 minutes, half hour.
And as you just mentioned, buy the dip. So you are focused on this particular theme. What are you talking about it?
Well, I mean, buy the dip is in many ways a very good thing, and it's probably something that's gone on forever. And in the piece I wrote today, I speculated that, someone in Mesopotamia was buying, olive oil, when there was a dip in the price, and that's been something that's been going on forever. It's human nature, with the one exception sometimes being the stock market, but it's human nature to buy things when the price goes down. That's economics 101. And but what's gone on now is it's almost become cultish, and particularly among U.S. investors since COVID. With the exception of a few months in 2022, every dip has been perceived as a buying opportunity. And over the last, say, 2 years, the dips have gotten smaller because everybody's decided that they need to front run each other to buy the dips. So I'm saying FOMO is actually outpacing actual fear because no one wants to miss that dip. The problem now is when you had a real sell-off like you did on Friday, which was based on some real economic concern. There have been some really lousy numbers in consumer sentiment, which were then backed up by lousy numbers from retail sales, which was then backed up by lousy commentary from Walmart. That was just sort of too much for the market to bear, and we sold off. And so you would have expected to, after a sell-off like this, to see a decent-sized rally, and we did get that 0.5% early on, but it faded, and we ended up giving back almost we certainly gave all that early rally back, and then basically call it another 0.5% to end the day.
And let's talk about the tech sector that was really getting dragged down, of course, ahead of Nvidia earnings. But do you think the Microsoft news also had something to do with it?
It did, because one of the concerns that I had around the DeepSeek, and I'm not alone in this, is that the DeepSeek model, and it still remains to be proven whether they're really the end all be all that they say they are. But so much of this market rally has been predicated on AI and a very specific way of achieving AI, and that is with lots of Nvidia chips, or maybe some Broadcom or AMD chips thrown in there, in huge data centers with huge investments. And we're talking multi-billion-dollar investments, 50, 60, $100 billion in investments from some of these companies. Well, what happens if one of these big companies who's been investing a lot in AI says, you know what, we don't need to invest as much in AI? That's kind of the fear that DeepSeek brought, was that maybe we can do this without these big infrastructure investments. It doesn't negate the promise of AI, but it sort of basically tells us that maybe we don't need quite as many chips from Nvidia. Maybe we don't need quite as many chips from Broadcom. Maybe Microsoft doesn't need to invest quite as much in data centers as a result. And so I think that there's a little bit of a turn here, not in the AI investment thesis overall, but in the way that it's being managed. Remember, history is full of disruption. And anytime you have a situation where excess profits are being gained, you're going to have competition come in. And I think back to the internet bubble when, the companies weren't as inherently profitable as what we're seeing now. But once companies saw the promise of the internet, others jumped in. And it's important to remember that Alphabet and Meta didn't exist during the internet bubble, yet they are the two most dominant players in the internet. So there's nothing that says that the most dominant player in AI infrastructure or AI software exists yet. Intel was the end all be all in those days for PC growth. Well, Intel's also ran. So there is a lot of creative destruction. So I do think we have to consider whether Microsoft's news is telling us we need to refocus the way we think about AI investment.
And you also note that there are some concerns the economy could slow because of the Department of Government Efficiency.
That is true. I mean, again, going back to economics 101, I don't mean to turn this into like a freshman economics lecture, but when we think about that, it's GDP equals consumption plus investment plus government spending plus net exports. Well, in the US, we've had a lot of government spending. to the point where a lot of people are concerned that it was problematic, that it's blowing up the deficit and creating inflation. Fair points. But if you're going to start to throw that G in the equation into sharp reverse, any of those changes have multiplier effects. And so as a result, the consumer's gotten very nervous because the federal jobs that are being cut, the federal programs that are being cut are not just in Washington, they're all across the country. And so people are getting nervous. And that's kind of why you saw the lousy consumer sentiment. And that's the problem that we're getting into. I'm actually starting to lean, there's plenty of liquidity out there, I'm starting to think that the economy could slow faster than people are ready for, and those people include the Fed. And so if you get a slowing economy and a Fed that's on the sidelines, that's something to be concerned about. And that's why you have on the thing the graphic there, don't fight the tape, insure against it instead. That's been my mantra, and that is, it's difficult when the trend is strictly moving higher to get in the way of that. But you do have to sort of consider whether it's with options or whether it's with raising cash, that you might want to take out a little insurance against pullbacks, because maybe the type of pullback that we saw on Friday is not going to be an isolated event, especially after we saw little follow through on the bounce today.
And with commodities, we saw gold touching a new record high. So just how far away are we from that $3,000 mark?
What are we, about $30, $35 away? I mean, that could be done. That could be done any minute now. I think, gold has been on quite an uptrend. If you look on a longer term chart, that uptrend looks a bit parabolic. Parabolic trends tend to scare me, but on the chart you have up now, that's fairly linear. Linear charts tend not to scare me. I think we're at a point now where there's a lot of money crowding in. There are some very specific features among the gold market, specifically people trying to get right now. There's basically a premium being paid for gold delivered in New York versus London, to the point where people are putting gold bars on planes and shipping them across the Atlantic, because there's about a $20 or $25 premium for U.S. delivery because of fear of tariffs. So it's a very disjointed market, and I think it is proving to be a bit more of a diversified hedge than certainly the digital gold is at this point, which has been moving somewhat in lockstep with NASDAQ rather than a hedge of its own. And so I think that gold is one of those things that when the trend is your friend, it's difficult to fight. And gold certainly has been in an uptrend, and I certainly understand the logic. So it's not something I want to get too far in the way of. And on the other hand, I'm not chasing it, but I'm certainly not shorting it until I get some sense that it's less relentless.
Great to get your insights, Steve. Steve Sosnick from Interactive Brokers. And just before we go, getting one final check on where the local market is set to open when trade gets underway. SPY futures are down 63 points. That does it for this edition of The Global View. Stick around, the open is coming up next.